Well, today, why don't we go over the Chapter 13-14 exam review. Our first question. XYZ is trying to decide which one of the two tours it will introduce. The costs and the revenues associated with each alternative are listed below. So we have Eastern Tour, Western Tour. We have projected revenue for each of them, variable costs for each of them, fixed costs for each of them, and the profit for each of them. And the question wants to know, what are the incremental costs of the Western Tour? So let's take a look. Okay, my explanation is going to be longer than the textbook's solution explanation because I want to explain some of this terminology. First of all, differential revenue is a revenue that varies within every alternative. A differential cost is a cost that varies with every alternative. And if differential revenues are higher than differential costs, then you're looking at a go situation. That is, you should do it. If everything else is equal, you should go on and do this. Now, if differential costs are higher than differential revenues, then it's a no-go. So if the revenues are higher, it's a go. If the costs are higher than the revenues, it's a no-go. So the differential revenue for Western versus Eastern, so we have Western is $12,000, Eastern is $9,000. Western versus Eastern is a plus $3,000. The differential cost for Western versus Eastern is a plus $6,000. So we have a 7 here, 1 here, and so the costs are higher by $6,000 for the Western Tour. And the fixed costs are not differential because they're the same for either tour. And the differential costs, that is the profit situation right here, it's higher for Eastern than it is for Western by $3,000, so that's a no-go. Now, differential cost of Western Tour versus differential cost of Western Tour is equal to the variable cost of Western versus the variable cost of Eastern. And that's the textbook solution. So the answer here we're looking for is, all they want to know is the difference in cost, the differential costs. Okay, that was the second line right here. And they're not looking for the bottom line, they're looking for the differential costs. So they're trying to get you to see if you understand those differences in those different terms. So the variable cost for Western was $7,000, the variable cost for Eastern was $1,000, and the differential cost difference would be $6,000. That's the answer. Second question, what's the differential revenue for this decision, alternative A versus alternative B? And all we're looking at is differential revenue. So that would be the $190 for A versus the alternative B, which is $260, and the differential revenue is $70,000. And it looks like it's in favor of B. Next, number 3. XYZ purchased a raffle ticket for $20. Just before the grand prize drawing, 2 people tried to buy this ticket. The first person offered $85 and another person offered $120. So what is XYZ's opportunity cost of keeping this raffle ticket? Well, the opportunity cost would be the higher offer of $120. So an opportunity cost is the sacrifice that is incurred in order to obtain alternative opportunity, and in this case, it's the $120. Let's take a look at number 4. XYZ company cleans and waxes floors for commercial customers. The company is presently operating at less than capacity with equipment, and employees are idle at times. That's a very important sentence there, so let me read that again. The company is presently operating at less than capacity with equipment and employees idle at times, which means they have excess capacity. The company recently received an order from a potential customer outside the company's normal geographic service region for a price of $9,000. The size of the proposed job is 22,000 square feet, and the company's normal service costs are as follows. Normally we do the following. Our unit level material costs are usually 18 cents a square foot. Our labor cost, these are all variable costs here, these two right here, are 25 cents a square foot, and our variable overhead is 8 cents a square foot. And then facility level overhead is allocated at 10 cents per square foot. So the question is this: if the company accepts the special offer, gain or loss by how much? So that's what we're trying to decide here. Are we going to have a gain or a loss, and by how much will it be? So operating at less capacity, the company will not incur any additional fixed cost for this special order compared to, so you only want to compare the differential revenues and the differential costs. So the only thing that's relevant here is if operating cost or capacity for this facility level overhead to be included, and you don't include it because we're not operating at capacity. Very important idea. So budget costs for production of 22,000 square feet for this special order would be as follows. We've got revenue, which would be, let's see here, unit level cost of for materials will be 18 cents times 22,000 square feet, or $3,960. And let's see, now again, let me go back up here and start over here. The revenue for this job is going to be $9,000. Okay, that's where we put it right here. And now we're going to look at the differential cost of this job, which the first one was material, and that's at 18 cents a square foot and times 22,000 square feet, or $3,960. Next would be the labor, which would be at 25 cents a square foot times 22,000 square feet, $5,500. And then the variable overhead, which would be at 8 cents a square foot times 22,000 square feet, $1,760. The total variable costs that are differential costs are $11,220. And the difference between the differential revenue, which is in this case this one job, versus the cost of this one job, we have, looks like we have a deficiency because our differential costs are more than our differential revenue by the tune of $2,220. So the other costs are not relevant because the company will incur them whether they accept the job or not. So unless you had some other reason other than making a profit, I would say this is a no-go. You might want to say it's a go only if you, let's say you come in here at a loss thinking that you might get business in the future. But other than that, this is a situation where you're losing money, and if you're just going to do it one time, I wouldn't, this is not what you want to do here. Number 5, or the next question, I should say. The XYZ company produces and sells a desk speaker for $220 rather. The company has the capacity to produce 62,000 speakers each period. At capacity, the cost assigned to each unit are as follows. Unit level cost, $105. Product level cost, $27. Facilities level cost are $17, and that's for each unit, each speaker. The company has received a special order for 13,000 speakers. If this order is accepted, the company will have to spend $22,000 on additional costs. Assuming that no sales to regular customers will be lost if the order is accepted, at what selling price will the company be indifferent between accepting and rejecting the offer? What they're really saying here is, at what point do we just not make any money or lose any money where we break even with our selling price? So let's see if we can figure this out. So the cost incurred to make a single product, that's relevant, that 105. The cost incurred to support different kinds of products are unavoidable, so therefore they're not relevant, that these product level costs. And then are facilities costs. These costs are incurred on behalf of the whole company. They're unavoidable also, so they're not relevant. So you're going to have these two costs right here at 27 and 17, whether you have this special order or not. So given that criteria, the only thing that's relevant here are these unit level costs of 105. So the budgeted cost for production of 13,000 speakers, that's this special order right here, the 13,000 speakers, would be as follows. Unit level cost, which are the only ones that are relevant, 105 times 13,000, which is $1,365,000. Other incremental costs are $22,000. They said they would incur these costs if they took this order on. So that's a total relevant cost of $1,387,000. And you take that situation and you say, okay, the other costs are not relevant because the company will incur them whether we accept the order or reject the order. And so these are the relevant costs in total. And you compare that to what we have as a selling price up here, or what would our selling price be. So at a minimum, the company would need to earn revenue of $1,385,000. So I had to pause this recording just for a second to take a very important phone call, but now we're all back to good. And so let's see. The moral of the story is that we've got to set a selling price that covers, all of the costs that we have incurred that are relevant here, which is $1,387,000. And so the way we're going to do that is we're going to say, okay, our price needs to be the 13,000 units for the special order speakers, and we're going to divide that into the $1,387,000 worth of relevant costs. And so our selling price cannot be any less than $106.69. So to summarize this problem, the only costs that are relevant are these unit level costs, and they're 105 a unit. And so 105 a unit times 13,000 plus the other incremental costs that we're going to incur to accept this order would be another 22,000. So the total cost would be 1,387,000. And if we want to figure out what a selling price is going to be to break even, we just take the 13,000 units and we divide that into the 1,387,000, and we get a selling price in order to not lose or not make any money, 106.69. Let's go on to our next question. Okay, our next question, on this exam, you're going to have a homework type problem that's like homework 13-3A. And so I'm going to work this 13-3A out, and here we go. Perez Company makes fine jewelry that it sells to department stores throughout the U.S. Perez is trying to decide which of the two bracelets to manufacture. Cost data pertaining to the two choices follow. So it cost of materials for bracelet A and bracelet B, 37 and 44. Cost of labor per unit, 33 and 33, which is for bracelet A and B. Advertising cost per year, $9,500 for bracelet A and $6,400 for bracelet B. Annual depreciation on existing equipment, $6,100 for A and bracelet B, $4,900. Identify the fixed cost and determine the amount of fixed cost for each product. So let's do that first. That's part A. So the fixed costs in this situation are going to be advertising and depreciation. Add those two together, and so the total fixed cost for bracelet A is going to be $15,600. The total fixed cost for bracelet B will be $11,300. So that's requirement A. Let's look at requirement B. Identify the fixed cost and determine the amount of variable and cost per each product. That's B. So the variable costs for each product are going to be, for bracelet A, material and labor costs of 37 and 33, or a total of 70 variable costs per unit for A, and 44 and 33 material and labor costs, added up to a total of $77 for total variable cost for bracelet B. And then in part C, which is the last part of the problem, identify the avoidable costs and determine the amount of avoidable cost for each product. So that would be the costs that are avoidable would be the cost of material, which is $37 and $44 respectively for A and B. and the advertising costs. Those are avoidable also, which would be $9,500 for A, and for B it'd be $6,400. So you'll see a problem very much like this one with just different sets of numbers, maybe different names, whatever. And that's all for 13. So let's take a look at 14. So for 14, our missed questions that we're going to take a look at will be, all this has to do with cash budgeting and so forth, so on for this chapter. So XYZ company completed its sales budget for the year, first quarter of year 2. Projected credit sales for the first 4 months of the year are shown below. So we've got these projected credit sales for the first 4 months of the year at January 38,000, February 44,000, March 53,000, and April 56,000. The company's past records show collection of credit sales are as follows: 38% in the month of sale, and the balance in the following month. The total cash collection from receivables in March is expected to be what? Well, I'm going to work the whole problem out every month and show you how this setup should work, and then we'll get down to the question they want answered, which is what's going to be collectible or what we should receive in March. So how are credit sales collected? 38% in January, for example, for January, 30% in January, and 62% in February. For February, collect 30% in February and 62% in March. And then for March, collect 38% in March and 62% in April. And then for April, collect 38% in April and 62% in May. So March collections would be February sales, because we're going to collect 62% of those February sales in March, which is a total of $27,280. And we're going to collect also March sales. 38% of March sales are collected in the month of sale, which is 38% times 53,000, which is $20,140. So that gives us a total of $47,420 that will be collected in March. So it's real important to understand what they're asking and for what month they're asking it for. The next question. Here we have a company expects the following total sales: March 21,000, April 11,000, May 33,000, June 16,000. The company expects 70% of its sales to be credit sales and 30% for cash. Credit sales are collected as follows: 25% in the month of sale and 75% in the month following sales. So here's what they want to know. The budgeted accounts receivable balance on May 31st is what? Okay, so let's go through this. And again, I'm going to lay the whole thing out, and then we're going to answer the question. So 70% of our sales are in credit and 30% are cash. So I will divide these things up: March, April, May, and June. So 14.7 would be credit sales, and then 30% of that would be $6,300 would be for cash sales. In April, $7,700 are credit sales, and $3,300 are going to be cash sales. That is for total April sales. And then for May, $23,100 are going to be the credit sales, and $9,900 is going to be the cash sales. And then for June, it'll be $11,200 for credit sales and $4,800 for cash sales. Again, I'm taking 70% of each of these numbers and getting the credit sales, and 30% of each of these numbers over here to get the cash sales. So now let's go on and get a little further in the problem. So how are credit sales collected? Well, they tell us that, for example, in March, we'll collect 25% of the credit sales, which is this number right here, 14.7. We'll collect 25% in March and 75% in April, the month following, right? Month following. Same thing for April. 25% of those credit sales will be collected in April and 75% in May. And then for May, 25% in May, 75% in June. And I've got what it's highlighted right here. That's what I've got that's important under, to keep in mind here, the 75% of May's sales collected in June. And then for June sales, 25% will be collected in June, and 75% will be collected in July. So the answer, and here we go, any accounts receivable balance on these sales at 5, we're going to answer this question. Are there any accounts receivable balance on these sales at May 31st, which would be, for example, for March. And the answer here for March is no, because all of March's sales will be collected either in March or April. Let's go on. For April sales, all the April sales will be collected either in April or in May. And now we're looking for the budgeted accounts receivable balance on May 31st. So we're getting closer. So as far as May sales, we'll collect 25% of the credit sales for May in May and 75% in June. So on the 31st of May, we'll still have 75% of the credit sales that will be outstanding or as an accounts receivable on May 31st. And then, of course, in June, the answer is no also, because in June sales, we'll collect 25% of those in June, the month of June, and 75% in July. So the answer here is the budgeted accounts receivable balance on May 31st should be basically 70% of May's sales times, well, anyway, the answer here is $17,325, which is $23,100. That's the amount of May sales that are on credit times 75%, which is this number over here. And that is $17,325. That $17,325 will still be on our books at May 31st because we won't collect it until June. Let's go to the next question. We've got the following sales budget shows the expected total sales for each of these months. January, 16,000. February, 20,000. March, 25,000. April, 48,000. The company expects sales of its 70% of its sales to be on account. And so if 70% of its sales are on account, that means that 30% are going to be in cash. Credit sales are collected at the following rate. We've got 25% in the month of sale, that's MOS. 70% in the month following sale, that's MOS, month following sale, right? And with the remainder being uncollectible or written off. So if you're collecting 25% in the month of sale and 70% in the month following sale, then 5% of your receivables are not collectible. So they want to know, when we get through doing all these gyrations, they want to know the total cash receipts during April. Total cash receipts during April. So let's go through this. Here's our 70% credit sales, 30% cash sales. Here's the sales that are on credit by taking the total sales times 70% for each of these months. So for January, we're going to have credit sales of 11,200 and cash sales of 4,800. For February, we're going to have credit sales of 14,000 and cash sales of 6,000. For March, we're going to have 70% or $17,500 worth of credit sales, and we're going to have $7,500 worth of cash sales. And then for April, $33,600 worth of credit sales and $14,400 worth of cash sales. And then how are credit sales collected? Well, we just said that before. They're collected 25% in the month of sale and 70% in the month following sale. So for January, 25% in January and 70% in February, and 5% are written off. For February, 25% in February, 70% in March, 5% are written off. For March, 25% in March, 70% in April, and 5% are written off. And then in April, the April sales, 25% are collected for April sales. The credit sales are collected in April. 70% of the credit sales are collected in May, and 5% are written off. So now, total cash receipts during the month of April would be calculated as follows. We've got March credit sales, which are going to be 17,500, and we'll collect 70% of those in the month of April. So that's going to be 12,250. That's for March credit sales. For April credit sales, we're going to collect, this looks like our credit sales for April are going to be 33,600, and we're going to have 25% of those collected in the month of April. So that's going to be $8,400. And then the last thing we're going to have for April cash receipts will be April cash sales of 48,000 times 30%, which is $14,400. And add these three together, and we'll come up with the total amount collected for April, which would be $35,050. That's the 70% of March sales, the credit sales. That's the 25% of the credit sales for April, and that's the cash sales for April. Total $35,050. Next, we've got the following information here. We've got XYZ provided the following information relevant to its sales for December year 1 and the first quarter of year 2. So for December year 1, we have actual sales of credit sales of 64,000, cash sales of 14,000. Year 2, in January, budgeted sales are going to be credit sales 144 and 29,000 for cash sales. Year 2, February, budgeted sales 159 and 34,000 for the cash sales. And March, year 2, budgeted sales 114 credit sales, 16,000 cash sales. Based on the company's collection history, which is 50% of credit sales are collected in the month of sale and the remainder is collected in the month following, they want to know cash collections in January from December credit sales would be what? So, December credit sales are going to be 50%. We're going to collect 50% of our credit sales in the month of December in January. And so this $64,000 worth of credit sales, half of that will be collected in January, and that's what they want to know. They want to know cash collections in January from December credit sales, and that would be 64,000 credit sales times 50%, which would be $32,000. Number 5. Number 5. XYZ company expects credit sales for January to be 50,000. Cash sales are expected to be 30,000. The company expects credit and cash sales to increase 10% for the month of February. Credit sales are collected in the month following in which the sale was made, and based on this information, the amount of cash collections in February would be what? Okay, so here's credit sales in January, cash sales, and we'll just put down what we got here in a little table form. So our January credit sales are expected to be 50,000. Our cash sales are expected to be 30,000 in the month of January. Now, the company expects credit sales and cash sales to increase 10% in the month of February. So let's do that. So for February, if you do what January is going to be plus 10%, you would get the following. You get 55,000 in credit sales, and you get 33,000, which is a 10% increase in both cash and credit sales. Okay. And now, based on this information, the amount of cash collections in February would be what? And that's based on how we collect things, which is credit sales are collected in the month following in which the sale was made. So how are credit sales collected? For January, we collect nothing in January from credit sales and 100% of the credit sale in February. Now in February, for February sales, we collect nothing in February and 100% in March. So going back to the original question, the amount of cash collections in February would be how much? Well, it would be the January credit sales of $50,000, right, times 100% or $50,000, and it would be the February cash sales, which would be $33,000 right there. Add them together, the total is $83,000. Now our last problem is going to be on the test. It would be just like or very much similar to Chapter 14, Exercise 14-2A on the homework. And instead of me going over it, I want you to watch the hint. There's a little hint video inside that homework problem. I want you to click on it and watch it. And I've already looked at it and watched it, and you should be able to do a problem like that on the test. So that's all I've got for you, and you have a wonderful day.